Hello, everyone. This is International Business Environment. So we didn't have any class this Monday, and instead of sharing with you the ideas face to face, I've created this video for you. So let's take a look of our topic of today. It's about international financial market. Now, first of all, what do we mean by financial? Financial basically means anything that has to do with money, vitamin M, money. And so I'm going to share with you something about the international financial market. First of all, when we talk about financial market, it has to do with companies being able to get money to run the business, to operate, to create products and services. Capital market is the system that allocates financial resources in the form of debt and equity according to their most efficient uses. As a business, in order to get funding to operate, there are two major sources. Number one is by borrowing money from a bank, we call it bank loan, or by issuing bonds. So when investors buy the bonds, basically the investors are lending money to that company. Another way of doing it is called shares, issuing shares. Basically, the company is selling the ownership of the business in exchange of investors' money. So the capital market, on one hand, allows businesses to get the funding, but on the other hand, it also allows investors to invest in business opportunities. Liquidity means how easy the assets can be converted into cash for people who buy shares and stocks or bonds from the capital market. They can easily sell those bonds or shares in exchange of money. We call it with a high liquidity. The importance of the international capital market includes borrowing and lending, investment, speculation, and also foreign exchange hedge, which has to do to insure against the exchange rate risk. Speculation is a little bit different from investment. Usually, when we talk about investment, it's about buying the assets and to generate income. But speculation is more about short-term buy and sell, meaning you buy something today and you want the price of that asset to be driven up tomorrow or 1 month later. So you try to make money by buying low and selling high. So debt financing It's the network of individuals, companies, financial institutions, and governments that invest and borrow across national boundaries. That may have to do with expanding the money supply for borrowers, reducing the cost of money for borrowers, and also to reduce the risk for people who lend the money to the borrowers. There are some reasons why the international capital market in general is becoming more and more active. Number one, it has to do with information technology. You can imagine how internet has led to the more efficient flow of money among countries. Number two, a lot of governments, they see the benefits of developing the capital market. They deregulate their markets. However, back in year 2007 and 2008, countries like United States experienced major financial crisis, and after that, a lot of countries have started to put back the regulations to prevent another financial crisis. Financial instruments about unbundling and repackaging hard to trade financial assets into more marketable financial instruments. Importance of the international capital market. So we have, for example, what we call the offshore financial centers, such as London, Switzerland, or we have like something called tax havens, like Cayman Islands, Bahamas. People who set up accounts there and enjoy tax, very low tax benefit. Now, bond, as we have said before, has to do with a company or even a government trying to borrow money from investors. So they issue some bonds in exchange of investors' money. International market includes the bond market, and it consists of all bonds sold by different companies, governments, or other organizations outside their own countries. There are two types of bonds that are very common. The first one is called the Eurobond. The Eurobond is a debt instrument that is dominated in a currency other than the home currency of the country in which it is issued. Foreign bonds are the bonds sold outside the borrower's country and denominated in the currency of the country in which it is sold. The interest rate affects the value of the bonds. We also have international equity market, meaning the market for selling and buying shares or stocks. Some reasons lead to the prosperity of the stock markets. Number one, privatization. A lot of the governments for the past few decades, they have decided to sell some of their assets to the private companies or allowing businesses to do the operation. So because of that, when those companies try to get funding, they will make use of the stock market. Another driver about the international equity market has to do with the economic growth in emerging markets. Companies based in emerging markets require greater investment as they grow, but there's a limited supply of funds available in the nations. Because of that, they need to make use of the international equity market to allow foreign investors to invest. Activity of investment markets help the equity market to operate more easily and efficiently. And also technology has played a part. For example, the automation of stock exchanges. People can buy and sell shares very, very easily. They can even do it online. Euro currency market is the market consists of all the world's currencies that are banked outside the countries of origin. And the sources of euro currency deposits can be governments, commercial banks, international companies, and also very wealthy families and individuals. Appeal of the euro currency market includes lack of the regulations. Also, there can be some not so good features, such as higher risk of default. Now, why do we need the foreign exchange market? When a company tries to trade with another company or with the clients in other countries, etc., there may be what we call foreign exchange rate risk. Because of that, businesses, in order to avoid the foreign exchange rate risk, may need to do something, including hedging, arbitrage, speculation. All of these are practices to manage the foreign exchange rate risk. Since you probably all came from your home country to study here in Canada, I'm very sure you know what we mean by foreign exchange rate. And think about if you need to convert the currency of your home country to the Canadian dollar, you need to know what the foreign exchange rate is. So this is about how you can read the most updated rates of the different currencies. Spot rates means the exchange rate requiring delivery of the traded currency within 2 business days. And spot market is the market for currency transactions at spot rates. Now, forward rate, forward market, those are all related to the future. For example, forward rate means the exchange rate at which 2 individuals, 2 parties, 2 companies agree to exchange currencies on a specified future date. And forward market means the market being set up so that currency transactions can take place at forward rates. Another way to manage foreign exchange rate risk is currency swap, meaning the simultaneous purchase and sale of foreign exchange for 2 different days. We also have forward contract, currency futures contract, and currency options. All of these can be used with the same purpose to manage, to avoid, to reduce the foreign exchange rate risk. Now, these are some of the major financial centers. For example, we have New York, London. Also in Asia, we have Singapore, Hong Kong, and Tokyo. Interbank market is the market in which the world's largest banks exchange currencies at spot and forward rates. Clearing is the process of aggregating the currencies that one bank owes others and then carry out the transactions. Securities exchange is the platform specializing in currency, futures, and options transactions. Over the counter, we usually call it OTC. OTC is the decentralized exchange encompassing a global computer network of foreign exchange traders and other participants. Convertible currency means the currency that can be traded freely in the foreign exchange market with the price determined by supply and demand. Instruments for restricting currencies include central bank approval, import licenses, multiple exchange rate system, import deposit requirements, and quantity restrictions. So basically, we are talking about some governments. For example, China doesn't allow money to flow in and out freely. So that's why those instruments would be set up for restricting currencies. Counter trade is the practice of selling goods and services that are paid for in whole or partially with other goods or services. So that's basically it regarding the international financial market. Remember, we have the international equity market, which is the sell and buy of the shares. We have the international bond market, which has to do with buying and selling bonds issued by governments, companies. We also have international exchange rate market, right, for people to try to manage and reduce the foreign exchange rate risk. Some cities have a lot of transactions going on regarding the international financial market. We call those cities the international financial centers. So this is basically what I want to share with you this week. If you are not sure about some of the concepts, we can talk about it next week. And also, the PowerPoint is available for you. Thank you very much, and have a very, very good weekend. Bye-bye.